Hey everyone, it's Evan here from the Trade Risk on Tuesday, March 27th, here with a midweek market recap video. We're going to cover all of the major markets and the current market environment. So we're going to jump in here with the S&P 500. We're looking at the cash settled market right now, and you can see it was a wild ride today. It's been a wild ride this week. And what's interesting about this week's action is we had a big update to start off the week on Monday. We basically gave it all back today on Tuesday, and that leaves us more or less flat on the week. And what that means for you is that if you watched my Friday video, our weekend recap, structurally, not a lot has changed given the fact we are still at sort of the same closing level as last Friday. You can see we're up 53 basis points here in the cash settled market for the S&P 500. So a lot of the comments that I'm going to make today are probably going to echo last Friday's sort of analysis. Clearly there's been a little bit of movement here, especially in some of the other markets that we can discuss. But for the broad indices, we're looking here now at the S&P 500. This is a weekly chart. Each bar represents 1 week of trading. So this is our long-term, intermediate to long-term perspective. And when we look at this perspective, we zoom out here, you can see we are still holding above this rising trend line, which extends from the 2016 lows here. We tested it on the first initial wave of selling back in early February, and you can see now we are essentially at a similar spot, a little bit further up the trend, the slope of this line here, and we're in the midst of sort of testing it again, sort of as we speak. Now, when we look here again at the structure of this chart, what we sort of talked about last Friday was this potential sort of bear flag here, which we did break down from, and it did essentially trigger last weekly close. So all the way down here, breaking below this trend line, breaking below there and closing right at the lows. And we talked about sort of a measured potential move for the ultimate sort of bear case here was a measured move from essentially the highs here down to the lows from early February. And if you project that from the top here down, you get somewhere around 2,400 or so. It doesn't mean we have to unfold in that scenario. And it also doesn't mean we're going to go there in a straight line. It's just a frame of reference, a path in which the market can take if it does follow the bear case to a T. And I think, when we look at this chart here, it is a high stakes level. This trend line here, these lows, if we start clearing below this 25.85, which was the closing lows from last week, I think this market can get really ugly really quickly. And it is something that, again, I don't like to spell doomsday or instill fear at all. I just want everybody to be sort of protected and understand that when we start breaking these bigger support levels, these bigger reference points, I know this is a trend line. I know it could be drawn in a handful of different ways. So by all means, do redraw this as you see fit. I do think, though, that it is important to recognize that risk is to the downside if we start clearing below these recent lows. The flip side is that if we can find support here, if we do hold this trend line, if we do hold 25.85 in the S&P 500, then perhaps we form some type of double bottom here and we can slowly start to repair this damage and work ourselves back up into this range. This would, morph perhaps into a wider trading range, and maybe, all is well in the world and we just have a very wide volatile trading range ahead of us for the next couple of months. That's sort of, the two schools of thought here. And like we aim to do in these recaps is sort of figure out where we are on these paths and these trajectories and look at where the path of least resistance is. For now, the path of least resistance remains lower. You can see we are below an 8 and 20 period weekly moving average here, and that is very close to getting a bear cross, almost, probably by the end of this week or into next week, we're going to start to see the 8 period cross below the 20 period. So that's the big picture outlook there. If we go back down to the daily chart, what we saw today, or what we saw this week, was a strong pop higher to start off the week, 2.72% snapback off of the Friday lows. And notice even almost a 3% rally yesterday did not even get us to the quick moving average on my chart, the fast moving average, that light blue line there, the 8 period declining exponential moving average. Even with a 3% rally, we did not even get back up to tag that. That goes to show you how much momentum and how swift last week's drop was for this market. And today, we had a gap up. We continued. We had an initial continuation to yesterday's reversal. They could not hold those gains. We covered the gap, went red, and got about as close as you can get to not being a bearish engulfing bar. If you do it here by the exact values, 2601.85, yesterday's lows, 2601.81. So, basically a bearish engulfing bar, but not quite if we want to be real sticklers with the closes there. So we have a bearish engulfing bar in the context of a strong sort of momentum move to the downside. This is a bearish event. We should assume or anticipate that sellers are in control here, which is why, again, risk is to the downside. But again, like I say, if we don't find follow through tomorrow, if we find some magical bounce higher, or maybe we start off with a small gap and reverse and go green, that could be some early signs that in fact we are trying to put in some type of structure here, some double bottom, some structure, I think is the right way to think about it, to potentially hold this market up, maybe bounce around and then start to lift higher. That again represents both the bull and bear case here. So it's very important to see how, whether or not we do get that follow through. I do think, again, risk overnight holds right now do have elevated risk. So you got to be careful, know your time frame, know why you own things, know where your stop is, know your position size. These are all important factors that we as traders need to pay attention to. And I think this is, increasingly important in this type of market environment. So that I think sums up everything I'm thinking about. And then just to hammer home and be really clear on the level I'm looking at, 25.85. You get that trend line that comes in here. You got this horizontal level from this structure in here. And then we do also have this reference point, the lows of last Friday, or not last Friday, early February's hammer reversal there at 25.34 all the way down here, would be another sort of a price structure level to pay attention to. So that's the S&P 500. Let's look here at the Russell 2000, the IWM. You can see very similar situation. We had this gap higher. We had a bearish engulfing bar, and this was the index that was holding up better. Let's go back to our first board where we got some lines drawn there. There it is. So you can see here that we are coming back into this support area. I think we talked about this general level right around 149.50 to 150 or so as being a potential bounce area into this week. We of course didn't really see that. We didn't really see that perfect bounce scenario unfold because we talked about that last Friday where we closed down here, and we were thinking of it more in terms of a gap lower to start the week for us to potentially pivot off of, and instead we had that big bounce Monday. We gave it all back today, and now we're kind of wait and see. Do we get follow through here? This is a significant spot for the IWM as well. You can see above that trend line that extends back from the 2016 lows and some horizontal support here. So Russell 2000, very much similar kind of spot there as the S&P 500, although notably, look where the February lows are. It's down here around 145, so there is some relative strength, relative outperformance here versus the S&P 500. We talked a lot about that in our past videos. Russell 2000 sort of doesn't really hold that same relative strength as of very recently, but it is still above this February pivot. And if we go to the Qs, One of the hardest hit today, kind of led to the downside, was the NASDAQ 100. You could see a very clear gap higher. The gap higher, the opening print was the high print of the day, and we proceeded to sell off all day and almost got that bearish engulfing bar printed here as well. 8 and 20 period moving averages there on my chart are bearishly aligned and kind of hammering down against price. We have this trend line that extends again from the 2016 lows right in here. 156.60 was a prior reference point. So once again, this market is at sort of a confluence of support area. Follow through tomorrow or a continued hold is going to be something that is very critical for this market, for the broad, sort of U.S. stock market as a whole. So that, I think, covers all of the major indices. Here on the Qs, again, for an upside level to pay attention to, it's this 164 level. We found a reversal there back in late February. We kind of failed here again today. We would want to get this market holding and closing above 164. Until and if that happens, we do need to be cautious here and expect risk to be to the downside. So that is the market environment. Let's get into some other major markets here. We'll go to TLT next. You can see a 1% pop here in TLT, kind of getting that fear crisis crisis alpha asset. That is a mouthful. Seeing a little bit of rotation this week, and in fact, it was a new trade entry for us here today. We got long TLT, we got long TMF actually, which is just a 3x bull ETF on the TLT, but we did put on some treasury today for this move here. Very quick, sort of tactical trade, not looking for a big home run here, just looking for some follow through. But essentially, I think well, let's look at it here, this 120.80 level. So actually, you know what? Let's go down to an intraday chart. So I think this here shows a good picture, kind of this rounded basing pattern. We know the long-term picture in TLT, it got hammered throughout December, January, and February, but then it based itself out, kind of a rounded base here, almost a cup and handle-ish pattern. I know it's probably not textbook, but you got this kind of rounded base here. We rallied up to resistance, we pulled back, and then we developed this sort of higher low, and we're trying to break out now, trying to make a second leg higher. So we put on some TLT here, and especially if the market continues to sell off, we might see more rotation into the safety haven treasury bonds. And really not looking to hit home runs here, looking to really, if we could get back up to achieve this target up here, a retest of this yellow line on this chart here, which is the big breakdown level from 2017, I think it would be a solid trade. That's essentially what we're looking for here. But TLT is a new entry for us. We'll see if it gets that continued strength into the end of the week, but making some moves here above recent supply and recent resistance today in TLT. USO struggling here. We talked about this as a potential kind of false breakout potential candidate. Didn't say it was a likely scenario, but said something to be aware of. And I don't know, again, it's not a trade that I have on myself because I do think it is, it's a counter trend trade in nature. But you can see here, USO rallied right up to this supply up here, the highs from January, and it's just kind of stalling out here, giving some, giving some indication that there is some hesitation here. So for USO, if you're really tactical with a tight stop, maybe shorting against these January highs here makes some sense. I don't have that trade on myself, but I understand the merit behind it. It is counter trend in the sense that the dominant trend has been higher, so something to be aware of, but maybe this has some room to fall and come back down here to carve out some type of wide trading range. That is a possibility. 8 and 20 period moving averages, momentum behind them, and bullishly aligned, so you got to be cautious there, which is why, again, it would be a counter trend trade, but something to pay attention to. Natural gas, nice bounce today, 1.5% to the upside, kind of, and continuing off of Monday's move. Yesterday's move was 1.6% higher. So natural gas is starting to lift itself higher. If it gets back above this 2260 level, clears above these moving averages, clears above this horizontal line in here, then I think maybe UNG is back in business for at least a short term, trade momentum. Bulls in control there in the short term for natural gas if it can get some more follow through and start clearing above 22.70. We had a short trade in this. Everything got covered here on Friday was the last exit for us on that short trade. So just in time to not endure this. And you could also look at this as a potential reshort up here if it starts to fail around 22.70. That could be a very likely scenario as well. So those are oh, and gold and silver, we didn't cover that. So GLD down today, 62 basis points to the downside. It had some initial follow through yesterday on Monday, sold off a bit here today. So on the week, it's essentially flat, down 12 cents, the GLD ETF. You can see we talked about last week, put in this nice kind of expansion bar to the upside for GLD. We're still long gold. We got long back here on the 1st of March. We sold some on Friday, right in here. We sold a piece at the top end of this range, thinking that a little bit of hesitation might come in here. So far, it seems to be kind of following that pattern right now. We are getting that hesitation, but I still like the potential here with the upward kind of bullishly aligned fast moving averages there. And that weekly chart, again, could turn into some big continuation pattern, bigger move that would take more time, but something that is promising if we can start to clear, I'd say above Monday's highs. I think that's a good reference point now, 128.60. Did I get that right? Yeah, 128.58. If we start clearing above there, then I think gold could really start to rip to the upside. I think the US dollar was getting a nice bounce today, so that put some pressure on, I think, commodities in general. Gold not immune to that either. So gold, a little down, but still holding up, still kind of in this pattern right now. And when we look at silver, finally also got hit here, down 1%, pulling off of the initial pop higher on Monday. And again, for silver, kind of the same comments we had last week. Really want to see this back above 15.95 or so. That would put silver in a much more constructive price structure pattern for us to trade to the long side until it's really kind of reclaim that, take and proven itself above this resistance. We want to be a little hesitant in this range. So that, I think, covers everything. No sector analysis here on the midweek video. Try and keep this a little bit shorter, even though I know this video still went long. Thanks so much for watching, for sticking it out if you made it this far. As I feel like these videos have gotten increasingly long recently as the market sort of heated up. Maybe I'm rambling a bit more, but anyway, thanks for tuning in. I will talk to you on Friday. Subscribe to our YouTube channel if you like these videos. Tuesday and Friday is when we publish our trade recap videos. So thanks so much again, and talk to you Friday.